All right. Well, hello, everybody, and welcome to Replace Your Income with Kevin and
Steve. How's it going, Kev?
Oh, it's good, man.
It's been kind of fun the last couple of weeks. We've gone on some road trips, spent some time, learning about some different marketing techniques. We've spent a lot of time talking about, real estate, different things. Anyways, it's been a busy, really productive, really, informative last couple of weeks. It's been awesome.
we went down to Las Vegas. That was fun. We had a great time there. We met some incredible people. Went to a great conference. And on the way down to Las Vegas, I had a really cool experience. I had another opportunity to see the windshield on my Tesla get cracked by a rock. It was great. We're really excited about it. That is the second cracked windshield. I got to tell you this. Look, I was talking to somebody who owns a Tesla. Her brother, he works at the Tesla dealership. And Elon, listen, I think I know Elon's money-making scheme. He makes crappy windshields because it's like curved glass. You have to pay like $1,400 to get a windshield replaced. And this girl who I was talking to, whose brother works for Tesla, has had multiple cracked windshields. So I think there's a secret money-making plan by Elon Musk. It's not X. It's not even Tesla. It's not SpaceX. It's windshields on Tesla. That's what it is.
Well, you did notice he just took another company public. It's a car windshield company.
Okay, see, all of a sudden it's all making sense now. No, it was awesome. The conference was great. And anytime that and that's why I think we love to do the podcast and why we hope when you guys listen that the podcast creates an environment for you that we try to put ourselves in, which is an environment where we're having lots of conversation, where we're talking about all kinds of stuff, and where our brains start to go through and spin through other ideas, other ways to look at the same topic. And this has also been the case recently because next week I have two separate opportunities to go and present who Done For You Real Estate is and what we do for our clients to two separate groups, financial planning type groups. One is a whole group of dentists down in Oceanside, California. The other is a whole bunch of people who are more kind of utilizing life insurance, and that's going to be here in Utah. But I've not given what I would consider a traditional sales presentation for DFY in like a long time. I mean, we used to do these presentations all the time. I used to travel all over and do these presentations, and it was years and years of fixing slides and honing the message. And that was such an incredible time to think about what we're saying and to think about what we're doing that we've actually decided to sort of usher in that as part of our next year, where we are going to be doing weekly live webinars. We're going to be doing events live to present and teach Done For You Real Estate right here at our office. And as I was building the slide deck, kind of thinking about the future, I found myself reorganizing some of the things that I've said in other sales presentations. And a sales presentation, all that means is we're just selling the viewer on the idea that real estate could be done for them and that it could give them the ability to create some walkaway income, to walk away money that they can kind of do whatever they want. And so we're not selling anything at the end of the presentation. It's just like, hey, here it is. And as I was going through the presentation, Stephen, I was kind of reordering it. I put a slide in there that I knew was going to be controversial, especially if somebody thinks about real estate a lot, even if they listen to this here podcast. It was a little, there's a couple controversial things I put in there, but the one that I want to talk about specifically is I used to go through, like we even do it in the book, like the 6 or 7 ways that real estate makes you money. And one of the first ones that we would always talk about is cash flow. Now, I still have some content in the sales presentation about the ways that real estate makes you money, but I took the cash flow slide and I moved it all the way to the bottom of the list, and I call it a bonus, not a given. Like I'm saying, here's these 5 or 6 ways that real estate makes you money, and bonus, there might be some cash flow as well. And I take it one step further, and I'm going to tell the audience that I would like, if we look at real estate, long-term big picture, and that's the key, long-term big picture, I could make the case that interest rate and cash flow both don't matter. Thoughts?
You just blew my mind.
I feel like the church
lady. I don't
even
know what you're talking about. No, like exactly right. I mean, we've talked about this like I don't know how many times.
Yeah.
Right. The idea that at the end of the day, cash flow, although it's in many or probably most investors' mindset, it's like that's the thing.
That's the thing.
And in fact, this whole podcast, our podcast is called Replace Your Income,
yeah,
which requires cash flow.
It does.
Right. And so, yeah, of course it's important, but the timing of when to focus on cash flow is an item of importance to know and understand. How to generate that cash flow with your real estate is super critical to really understand and to understand its place in the overall goal, like its place today in the overall goal to create this cash flow. In fact, Kev, I sent a text to one of our clients literally right before we started this podcast to have a conversation with myself and with Mike Chamberlain to talk about another concept that we'll talk later on in our podcast called Buy, Borrow, Die.
Yeah, I think we can touch on that today too because it's part of the same conversation.
Yeah, because the question that this client had posed to me is like, it's so funny. He's been doing this for years.
Yeah.
And he owns multiple properties. He's
Yeah.
like, hey, Steve, can you remind me why we're doing this again? It's kind of like,
Yeah.
like he's just been buying up these properties and buying, and he kind of lost sight of like the end goal. Like,
Yeah.
what is it we're trying to do? Yes, cash flow is super critical at the right moment in time. And it would surprise many of our listeners, like the strategies that can be employed, because the ultimate strategy is to create significant, if not massive cash flow one day with zero tax liability.
There you go.
And that's the end goal,
Yeah.
right? So, but on the way to accomplishing that and achieving it, this whole concept that you're talking about, that cash flow really doesn't matter today. And guess what? Neither does interest rate. Of course they matter in the grand scheme of things. They matter today in a certain way. But where they don't matter or where they shouldn't matter is if they're keeping us from executing our plan, then we should forget all about them completely. And they don't matter and they shouldn't matter.
All right, so let me give you an example on interest rate, right? So this is kind of what I mean in terms of interest rate and cash flow don't matter. Okay, so let's say we buy a home today or we bought it 20 years ago. It doesn't really matter. In fact, let's use the example. Let's say we bought a home, we'll go 10. We bought a home 10 years ago, okay? During that 10 years, the home is likely increased dramatically in value. Now, let's say that along those 10 years, the interest rate was what I consider to be trash, right? Let's say it was like 15% even. I don't care. And let's say that I've been unable to generate cash flow on that property during the last 10 years, okay? High interest rate, no cash flow. Let's just assume that my expenses were at least covered, okay? Now, if I wanted to do something with that home today, would I look at, maybe I bought it for 100 grand, 150 grand 10 years ago. Maybe today it's worth 300,000. That would not be unrealistic, right? So if I have a home that I haven't made, I'm using air quotes, that I haven't made any money on, that's been an expensive interest rate for the last 10 years, and today it's worth 300,000 and I bought it for 150, does that mean, was that a bad investment? Because it doubled my equity. And you know what an interest rate then and now gave me the ability to do? Like, I wish that we would look at interest rate as the master key to riches. There's actually a Napoleon Hill book called The Master Key to Riches. And I've been thinking about that lately. Like, interest rate for me is the master key to real estate riches. But interest rate in terms of a number doesn't matter, because this is why I call it that. Because interest rate unlocks something. Do you know what interest rate unlocks? Interest rate unlocks your ability to acquire a property for significantly less than what the property costs today in order to take advantage of all of the growth and benefits from that property, and even usher in the opportunity to generate tax-free income. Now, when we talk about tax-free income, this is what you were alluding to. Like, let's say that property, it's covered my expenses for the last 10 years, okay? But it hasn't generated any cash flow and it's had a high interest rate. I haven't refinanced, I've just let it go. let's say today that property is now worth $300,000. If I wanted to go and do a cash out refinance, right? Let's say I want to go and cash it out for $240,000. Now, if it was worth $150 and somebody else has paid down my principal, let's just assume I owe $100,000 on this home that I've had for 10 years. It's worth $300 and I could do a cash out refinance at $240,000 today. That $140,000 that would come from my property that I did effectively nothing to earn. I owned the property. We kept a tenant in it. But the interest rate, even if it was 15%, gave me the master key to unlock this growth potential. And if I were to go refinance today, regardless of what the interest rate is today, and I could pull that $140,000 out of that property, how much tax do I have to pay on that $140,000? Oh, interesting. So are you telling me that in theory, I could take that $140,000 out of my property, not sell the property, but let's just say I wanted to spend the $140,000. Let's say I wanted to go buy a tricked out, like, let's say I wanted to buy a Corvette, right? I don't know why, but let's just say that's what I want to do. Are you telling me I could pull that $140,000 out, tax-free, go buy a Corvette cash, and still hang on to my property that my tenants are still likely paying for and continuing to pay down the principal? All of a sudden, I got 6 figures of tax-free income because the interest rate is what was the master key to unlock the riches that were found in that real estate. The cash flow didn't matter and the interest rate didn't matter. And that's the only thing I'm saying with that idea, is that it's principally, I don't think we look at real estate like this often enough.
So here's one other way to look at this, Kev. So let's say that your interest rate is such that you are going to have, you're going to be at a break even at best, maybe even negative for that matter. But let's just, for sake of argument, for this illustration, let's say there's just a break even. And so you buy a property at break even. And so there's no cash flow. There's no immediate benefit where you can't go to the store and spend money from that property coming in every month. Mm-hmm. Like you just mentioned, right? You still have all the other things working for you. So let's look at this from this scenario. So from a cash flow standpoint, it's like you didn't buy a property.
Yeah,
and so you made the decision. Yeah. It's like, I'm not going to buy the property because I can't cash flow. So let's say that because let's just say that I'm, although this is stretching, things. Let's say that I'm intelligent enough to buy this property. And my buddy,
the intelligence thing is a stretch.
And my buddy, he's like, why are you doing that?
Yeah.
You're you're not even breaking even. He's like, I'm not going to buy a property. And you're like, well, I am. And so you're walking along in life, and over the years, my beard's getting a little bit grayer. His hair's getting a little bit grayer. We're getting a little bit fatter, the whole thing, right? Mm-hmm. 10 years down the road, I bought this property and he didn't buy his property and he didn't have any cash flow and I didn't have any cash flow. Yeah. Now, what you just described there at the end of 10 years, well, now this thing that I bought, and let's just say again, for sake of argument, that I never raised the rent and I never got any cash flow for the whole 10 years.
Yeah.
And then 10 years later, we look at each other and he's like, man, you were so dumb for buying that property. It did nothing for you. You did all this work and all this stuff. And he's like, I didn't go to the trouble and I didn't have this liability of a loan hanging over me. Now it's 10 years later and let's take a look. Neither one of us had cash flow. But at the end of the day, just like you just described, my property that I bought for $100,000 is now worth, $200,000. Yeah. My tenants have paid down the principal. So now, the down payment or the equity that I have is even greater because they paid that principal down every month. On top of that, one of the benefits I did get every year was he paid about $6,000 more in taxes because we have the same job. We work the same hours. We get paid exactly the same. Well, actually, we didn't get paid the same because I got to deduct about $6,000 off my tax bill every year or from my income and he didn't. And this whole thing, the appreciation they talk. So this concept of cash flow, it doesn't matter, right?
Yeah.
I don't know if that scenario makes sense to you, Kev.
Oh yeah, 100%. And I'm sitting here and I'm thinking, okay, let me extrapolate it out even further. here's where else you and your friend would have benefited, okay? Let's just assume for a moment that you put 50 grand into that property, all right? Let's say that he put 50 grand into a 401k over that 10-year time frame, right? Like he didn't have it. You had it to go buy the property. Let's say he didn't have it. Let's say he contributes it over time. Okay, when you sell your property, if you were to sell the property, you're only taxed on capital gains, not capital contribution, correct?
Right.
Now, as he's contributing money to his 401k, he's getting a deduction for contributing that money, but then when the money comes out, he's still going to be taxed on it, right? So you're already ahead of the game from a tax standpoint. In addition, over those 10 years, he's been funding the retirement account and hoping that it grows. Who's funding your real estate retirement account?
My tenants.
The tenants. So you were smarter because not only are you not future taxed on your principal contribution, and if you were to refinance the money, you're not taxed on the money that comes out. And you were smarter because you weren't contributing to something that both will later be taxed and you're personally having to contribute and hope for the market to grow. You have somebody else funding your investment instead of you funding your investment, and all of that without once having to consider interest rate and cash flow.
Exactly.
Like, dude,
you can't make this stuff up, Kev.
It's crazy. And if you just look at appreciation, right? Like just look at appreciation, okay? We know that real estate will continue to appreciate. There will be times when it doesn't appreciate as much. There will be markets where it doesn't appreciate as much. There may even be times, I doubt it, but maybe if we had a massive financial correction, whatever, you could see property values go down temporarily. But in the presidential debates, even both parties are acknowledging that there is a massive shortage of affordable housing, okay? Now, shortage of housing is the operative phrase here. Shortage of housing means demand, but not supply. But if you own the supply where demand is high, then no matter how much you try to force feed bad economics into a capitalist system, the invisible hand is at work, okay? So you want to own supply where demand is high because there will be an upward pressure on the prices of that supply. So, no matter how you slice it, owning real estate will create some appreciation over time, period, okay? Especially if you do the right property in the right market with the right set of conditions. But what's interesting about that is okay, we don't know how much the property is going to appreciate, all right? We know there's a shortage. We know that we're on the right side of the supply and demand curve, all right? We know all of the other benefits that we were just describing with a property versus your friend who didn't buy a property, or in my example, a property that I made nothing on for 10 years and whatever, however we want to word it and talk about it. But if you look at the appreciation on just an average property, okay, what we know is for the last 100 and something years, appreciation has averaged at a minimum 3.5%, okay? Do you know that means that if the economy just yields an average of 3.5% between 10 and 15 years, your property value doubles? And if it does 5%, it's 10 years that it doubles. And if it does 7%, it's less than that, which just, dude. So look, I don't have a whiteboard. I'm not going to beautiful mind the thing. You could go ask ChatGPT. In fact, you should do this, everybody. If you have a ChatGPT account, or even if you don't, go and say, if I bought a home today for $300,000 and it appreciated at 3.5% for the next 10 years, how much would it be worth in 10 years? How much would it be worth in 15 years? How much would it be worth in 20 years? And what you're going to see is it's going to blow your mind. I have this example that we actually put in the intensive, which is, and I talk about it all the time on the podcast, my parents' home, all of the fluctuations of economies, and all of the fluctuation of interest rates, and all of the fluctuation of presidential administrations, and all of the fluctuation of, times of economic crisis and recessions and all that, dude. End of the day, it was the time that created wealth for my parents because it was attached to real estate. And I just hope, you guys, if you're listening, I just hope that you will come along this, and look, full admission here, Steve, you and I and our team, we haven't even been fully, I think, acknowledging the power of real estate in this regard. Because even we, as real estate investors, as owners of Done For You Real Estate, as the team that's helping all of our clients do real estate. We've even been sort of like obsessed with cash flow, right? For years. It's like, and then when cash flow started to go away, it forced us, because look, for the average lay real estate investor, right? And all I mean by that is like somebody that this is not the number one thing that you think about all day, every day, all of the time. When cash flow goes down, it could be a really simple explanation. That's the most important to me. I'm not going to invest. For us, we're not getting out of real estate. We're always going to be in real estate. So if cash flow goes down, we have to look at ourselves and say, does it still make sense? Is it still worth it? And what's been so crazy is now in this environment over the last couple of years, as we continue to drill down additional layers of what real estate does and provides for us and for our customers, I think we are more convinced than ever of the power that is available in this kind of real estate. And it's all in this discussion right here. We've never, frankly, talked about real estate quite like this in these terms, where we've said interest rate and cash flow don't matter if you look at it in this context, right? This is even new for us, just in terms of really talking about it in this way. We've known it, but really sort of focusing in on this aspect.
Yeah, we just haven't framed it quite this way.
Yeah.
And what's interesting is we're heading into a time period where cash flow is naturally going to improve.
Yeah.
And so I think it's timely from that standpoint that it's not, it's something that we're going to get more of, but we're helping people understand that it's not that important anyways.
Yep.
Right. So we're not having this conversation because cash flow is going down. We're like, oh, what are we going to do?
Right.
Like, we're having this conversation because we continue to have these epiphanies as to how to frame this conversation to help our clients understand what it is that they're really getting themselves into.
Yeah, 100%. And so we hope that this is a shorter episode today, but I think it's because I want you to, if you're listening, I want you to go back and re-listen to this, and I want you to chew on the example that I shared and that Steve shared. And I want you to chew on I love our brains have this really remarkable capacity. When we feed our brains a question, our brain starts to work on it to try to answer it, right? So that's effectively what we've done today. That's the exercise. So if you're listening, I just want you, based on if you've listened for a long time, you know how we look at real estate, you probably look at it the same way. I want you to ask yourself the question, if I assume that interest rate and cash flow don't matter in my real estate, does it still make sense for me to own and buy real estate? Ask yourself that question and allow your brain to chew on that and work it through. And I'll tell you, I know exactly what you're going to find, because it's exactly what we found. There are so many reasons why it still always makes sense and why it's always the right time to buy, like we've always said. If you look at what you're hoping your real estate is going to accomplish for you in the long run, what is that thing? We give game plans, we talk to people, but I don't know how many of you have really sat and said, what is it that I want the real estate to accomplish? Because if it's an amount of money, there's different ways to get there. If it's a certain amount of cash flow, it could be owning a portfolio that produces that cash flow. It could be owning a portfolio that allows you to refinance chunks of capital out and then spread that capital over a certain amount of time so that you can increase your standard of living while owning the real estate continually, right? I want you, if you're listening, to ask yourself the question, why am I doing real estate? What am I wanting to accomplish? What is the actual long-term goal? And I would make the case that I think what we're all really looking for is walk away money. We want to be able to walk away either from the job we don't like, or the part of the job that we don't like, or the job altogether, or we want to walk away from the idea that the job is the only way that we generate income. We just want to walk away. We want to be able to walk away from something that's anchoring us, holding us down, holding us back. And real estate gives us the ability over time to create that kind of walk away money. So I want everybody to just kind of think about that, chew on that, and think about it for yourselves, because it might lead you down an interesting road.
Love it. Very good.
Awesome. All right, everybody. Thank you so much for joining the Replace Your Income podcast. We'll talk to you real soon.
Take care.